Okay, it's about 5 after, so let's go ahead and get started. We are so delighted to have Melanie Britton with us today, and we thank you all for signing up to participate. My name is Allison Forche, and I am a relationship manager with Gerber LLC. We help growth-minded business owners build rockstar businesses and live happier lives. Our successful clients are industry leaders. They lead happy and fulfilling lives, and they make money while doing this. Our Triple E, Emerging Entrepreneur Experience, is a forum-based program that provides processes, strategies, and sequencing for success. Annual revenue is $200,000 to $3 million. And we are taking this program 100% online as an option to our forum-based program in September. Gerber Clarity takes it a step further by helping you understand what your business can do personally and tying in personal and financial goals and dreams of the business owner to live happier lives. Melanie Britton holds an BBA in finance from Ohio University. She is a consultant specializing in finance and operations who partners with business owners, CEOs, and executives to tackle their biggest challenges. After spending nearly 20 years working in financial planning and analysis, strategy, and operations, Melanie knows how to assess key performance indicators and advise her clients so their businesses can reach peak profitability. Melanie creates customized recommendations for each client with their short and long-term goals in mind. So it is a pleasure to welcome Melanie this morning to share with us this great knowledge. Thank you.
Thank you very much. Thank you all for joining this morning. I know Monday mornings everyone wants to learn some math, so I'm going to go ahead and share my screen so you guys can see the presentation. All right, hopefully everybody can see it. Again, thank you all so much for joining. Originally, when we were discussing putting something together on key performance indicators, we talked about doing kind of a workshop forum since KPIs are so specific to every industry and every company. But obviously with the state of the world right now, that wasn't going to be feasible since we can't all get together in a room. So I did my best to put something together with a variety of information, and hopefully everyone learned something today. Some of it might be a little elementary for some of you, some of it might be way too much information, but hopefully everybody takes something away from this. We're going to go through some definitions, look at how to calculate some KPIs, and then we're going to kind of pretend to set goals that make sense with the annual financial plan. So our discussion topics today, I'm going to give you just a little bit about my background so you know who's talking to you. We'll go over what a KPI is, how to create KPIs, determining which KPIs to track for your business, common KPIs for your industry with some calculations, how KPIs relate to the annual budget, how to set KPI goals, and the cadence for tracking your KPIs. A little about me. I started off working in litigation consulting. More specifically, I worked on business interruption cases, calculating financial losses for my clients that they had suffered due to a disaster-related closing. So some of you guys might be familiar with that right now because everyone tried to tap into their business interruption policies to see if a pandemic is covered under them, which of course it's not. So basically, most of my clients were hotels and resorts that were badly damaged by hurricanes, businesses that were impacted by the 9/11 terrorist attacks, and companies that suffered from environmental disasters like oil spills, coal mine collapses, really, really uplifting things. And then I left there and I went to the Chicago Tribune and I worked in a specialized financial strategy team there. And my group was in charge of testing the financial viability of all new product initiatives. We did revenue forecasting, created like new pricing structures for the advertising revenue, and built management reporting suites. And while I was there, I got a taste for the advertising and marketing business. So then I've worked at several advertising agencies where I've always worked in financial planning and analysis or in some operations capacity. And a lot of the same work I did at the Chicago Tribune: management reporting, annual financial planning, revenue forecasting, ad hoc analysis, and implementing new accounting and project management systems. And then about 5 years ago, I decided to go off on my own. I found that I really had a passion for the education and partnership aspects of my job. And so by going off on my own, I'm able to have many relationships with several small businesses, and it's just been a really great fit. So I work with them on all financial and operation aspects of their business. All right, so what is a key performance indicator? A KPI is a type of measurement that helps you determine how your organization is performing. KPIs are a critical part of managing your plan on an ongoing basis. While not all KPIs are directly related to your annual financial budget, they are all factors in your short and long-term company goals. So think of it like you might have a KPI where you want to improve your customer satisfaction score, and that's a perfect KPI to have, but that doesn't necessarily tie directly into your annual financial budget like having a revenue growth KPI goal. So there are some that tie directly into your annual budget and some, like a customer satisfaction score, that wouldn't. And then KPIs can be at the company level or more targeted to a specific area or department of the business. So every KPI must have a measure. So this sounds obvious, but there must be a clear expression of what you need to measure. So you can't just say, I want to do better work. You have to know what you're measuring to show that you're doing better work. Every KPI must have a target, and the target must match your measure and time period of your goal. So if your measure is a percentage, your target also has to be a percentage. Every KPI must have a data source. So you need a clearly defined data set so you're always comparing apples to apples. And every KPI should have a reporting frequency. So you need to know if you're going to be looking at them weekly, monthly, quarterly, annually, etc. So when you're designing key performance indicators, you need to ask yourself some questions. So the first one is the KPI derived from a valid strategy? So you can say, I want to add 10 clients this year. And I'm going to ask you, well, why do you want to add 10 clients? And hopefully your answer isn't just because I want to add 10 clients. Hopefully your answer is, I want to grow revenue by $100,000 this year. And on average, my clients bring in $10,000 a piece. So that's why I want to add 10 clients times $10,000 to hit my $100,000 revenue goal. Are they simple to understand? So that's the next question you would ask. So could everyone at the company understand what the KPI is and basically how you would calculate it, what the inputs are to calculate it? So it should be someone in a creative department can understand it the same way someone in finance and accounting could understand it. Is the KPI relevant not just now, but over time as well. So is the KPI part of your longer term plan, not just something you want to achieve in the next 2 months? Is it clearly defined? Does it focus on improvement? And does it offer quick feedback? So when you're designing KPIs, there are some challenges. So the first one is there has to be a clear business strategy. So if you don't know where you're going with your business, you don't know what you should be looking at to get to where you need to be because you haven't decided where you want to be yet. The second one is accuracy in measuring and reporting. So you have to have some systems and tools in place to be collecting the data in order to do the calculations. And you don't have to have some sort of robust, expensive accounting and project management system. I mean, you can have someone who sits all day and enters data in an Excel spreadsheet and QuickBooks. I mean, it doesn't have to be something super robust and expensive, but you have to have a way to track the information. And then the third one is buy-in, because in order to hit your KPI goals, the whole company needs to be on the same page. And so everyone needs to buy in order to achieve that goal. So when you're determining which KPIs to track, it's kind of a process you go through to get there. So the first thing you need to do is do a deep dive into your financials to see where you stand. So you need to understand your P&L. You need to try to identify areas that look like they require attention. And if you're not an accounting person, it's probably great to sit down with somebody that can explain a lot of that to you, and then you'll pick it up really quickly and be able to, the next year, to be able to start identifying some of that stuff yourself. So the second thing is you need to think through your long-term goals, so the next 2 to 5 years, and write them down. And what are those goals? Because that's going to inform what your KPIs are. So do you hope to have rapid growth? Do you hope to sell the business in 5 years? Are you comfortable maintaining the same size of organization that you currently are, but you just want to really focus on improving your bottom line? So those are some things that you need to think through before you determine which KPIs to track. And then based off your long-term goals, you need to write out your short-term goals. So those will obviously be your first steps in achieving the long-term goals, and you can kind of develop your KPIs based on, what you can calculate first in order to achieve those goals. And a lot of times what your first KPIs are going to be are the things that you can calculate now, because there's going to be things that you identify that require attention, but you just don't have the setup yet to be able to make those calculations. So that goes to the second to last bullet point. So are there things that you could calculate in the near future if you started tracking the data now? So once you kind of identify those areas of concern, there might be some places where you could be keeping better track of the data so that in the future, 12 months from now, you could start using that information for a new KPI. And then the last thing is to keep it simple. So focus on 5 to 7 metrics is my recommendation. I think a lot of small business owners, they want to have every data point there is and constantly be like looking at everything. And so analysis paralysis is real. And so if you have too much information that isn't actionable, it can just be overwhelming. So you need to just find those 5 to 7 really key core measurements and just really focus on keeping those current, and that will really help improve your business. All right, so we're gonna walk through some common KPIs, and we're gonna do a few calculations too. So keep in mind that some of these calculations might vary slightly for your individual business. Everyone's just a little bit different, but this should give you a pretty good idea as to the approach once we get into some of the calculations. So the first key performance indicator that's extremely common is revenue. And I'm sure there's a collective duh from everybody, but there's a few different ways to approach revenue. So the revenue goal can be set for an individual business segment or the company as a whole. So you might find that one segment of your business is just more profitable than the rest of it. And so your revenue goal that year could be just to grow that segment of the business, and you're not so concerned about your revenue in the other segments. Therefore, your overall revenue goal for the company might stay the same as the prior year, but you're more focused on just growing the profitable revenue. Revenue is one of the biggest drivers of the annual financial budget, as you'll see when we get a little further in how all your calculations are based on what you want your revenue goal to be. And finally, it's okay not to focus on revenue growth every year. Sometimes other aspects of the business require attention in order to improve the overall health. Other times you have just no control over your revenue. There's outside factors like a global pandemic where I'm assuming most people's revenue is not growing this year. I hope it is, but so you have to just kind of plan for whatever happens, and revenue growth is, some years you can have the same as last year, or some years you can plan to be 20% lower. It's okay. It's just you need to know that when you're building your plan so that you can have all your other factors in line with that new revenue target. So the next key performance indicator is client diversification. So this is a growth strategy that involves adding services and or markets to the core business. So think you want to put your eggs in as many baskets as possible to minimize risk. It's important not to be dependent on one or two clients to sustain the business or to have a full client roster from one industry. So think, I'm just going to pick on an industry. So think the retail industry, and all your clients are from the retail industry, and retail's not doing well. You don't have anyone to offset retail's poor performance. Diversification can be done through growing current smaller clients or adding new business. And this KPI is really challenging to control, but it's important to monitor. So the reason it's hard to control is pretty obvious, but if you have one client that is 50% of your revenue and they want to spend more money with you, you're obviously not going to turn down the work and say, oh no, I can't take this extra revenue from you because you're going to now be 60% of my revenue instead of 50%. You're obviously going to take the revenue, but you need to just keep that in mind and keep trying to grow your smaller clients or focusing on new business. So expense reduction is the next KPI. So it's important to set some goals for reducing non-project related expenses. So you can target a specific area where expenses are too high. So for instance, you're going through your P&L and you see that every year your training and conference budget keeps growing and you're like, okay, this is getting out of control. So this year we're going to focus on reducing that specific expense. Or some people will determine a revenue to expense ratio that can help facilitate achieving their net income goal. So you need, for instance, expenses to be below 40% of your revenue in order to achieve your 10% net income goal. So there's just kind of some math in there to figure out what works and what's reasonable. And then another method is just to reduce your overall expenses by a specific percentage. So we're going to do a 5% reduction across the board everywhere we can. Let's go through and see how to make this work. All right, so the next KPI is utilization. So utilization is probably one of your most important KPIs. Payroll is most likely one of your biggest expenses, so it's important to make sure your staff is busy. Utilization will also help you learn if you have staffing needs, if you have certain areas where people are always 100% utilized, or you might find out, unfortunately, that you're overstaffed and you need to make some reductions or move some people around. So it's just very important to always be tracking how busy people are. So I use 4 common categories. So billable time, which is time spent working on billable projects. Productive time, so that's new business time, pitch time, client service people who are putting time to non-billable client time. So, you know, growing relationships with current clients. I don't like to penalize, you know, have that count for like internal time when it's very important work that should be growing your business. So I like to have that be a separate category. And then internal time, so obviously internal meetings, internal projects, or just unassigned time. Someone has to sit there for 8 hours or put 8 hours in their timesheet. And let's all be honest, we all have an hour sometimes where we don't have anything to do when we're working in this type of business, and we're especially junior staff. And then finally time off, so PTO, holiday, short-term disability, things like that. So let's take a look at some fake timesheet data just to go over how you would calculate this. So this is Jane's timesheet, and this is 1 week of data. So you can see at the bottom, it's 40 hours. And we have billable time, productive time, internal time, and time off if you look in the type column. And so it's just simple math. So there's 28 hours of billable time. So 28 divided by 40 is 70%. Same for productive is 2 hours divided by 40, internal 2 hours divided by 40, and time off 8 hours divided by 40. So we see here that Jane had 70% billable time and 5% productive time. And obviously there's a bigger picture at play because we need to see what the company average would be, what her department average would be, but I just wanted to kind of give you an idea for those of you who haven't done utilization before, how you would calculate that. So what should you do with this information? So a few things to think through when you look at it. So if an employee has a lower billable utilization, there could be some positive reasons why and also some negative reasons why. So like we talked before, if this employee has a high productive utilization because they were the lead on new business pitches or things like that, you definitely don't want to be penalizing them if their billable utilization was lower because they were spending so much time on new business. Was this employee assigned to an important internal project and therefore didn't have time to work on billable work? So let's say you decided you wanted to redo your company website and you pulled a creative resource to work on your new company website. Obviously, you're not going to penalize that person for not being billable because they were helping you do something important for the business. And then the other question to ask, though, obviously is a little more negative. If there's a lot going on, a lot of time going to the internal category for no reason other than there wasn't enough billable work, then there's the possibility that maybe you're overstaffed or just going through a slow period of the business right now. And then the other part is it's always important to look for employees who might be too utilized. So does an employee have a really high billable utilization and also a high productive utilization? So are you burning somebody out because you're keeping them on project work and having them work on all your pitches? Or is one employee in a department significantly more utilized than others? So the person in charge of doing staffing, can look at that and do some adjustments to kind of even it out. Next KPI that we'll talk about are effective rates. So your effective rate is the actual hourly rate at both, and you can calculate it both at the client level or down lower at the project level. The effective rate is necessary to show the variance between the budgeted rate and the actual rate. This metric is typically most informative for fixed fee projects and retainer clients. The reason being, your time and material projects should have an effective rate similar to the budgeted rate, unless you are having a lot of write-offs, and then that's a story for another day. But typically this is most beneficial for your fixed fee and retainer clients. So if you take a look at this, so the first column is your budget or your scope, and you had a $25,000 in revenue and you were planning for 125 hours. So your budgeted hourly rate would be $200 an hour. But now we're done with the project and we see that we overworked it and we worked 150 hours instead of the 125 we budgeted, but we weren't able to submit a change order for more revenue. So now our effective rate, or your actual rate, is $167 an hour. So what should you do with this information? So you can assess how well projects are scoped. Are certain types of projects or projects for specific clients always going over or under hours? And then if you have a project type X that's always going over on hours, then you can start to see trends there, and the next time you budget a project X type that you put in some more hours. Your effective rate can also give you insight into which clients or types of projects give you the most bang for your buck. So you have company A that you always work with, and they just always stick to the scope. They never ask you to tweak anything. So your effective rate's always going to be a little bit higher with them, and you're probably going to seek out doing more work with clients like that than the ones where your effective rate always starts dropping. And then your effective rates are an important factor when building the annual financial budget by informing both the revenue and staffing and contractor needs. And we'll get into a little bit more of that later. The next KPI is the percent client and project margin. So this calculates the percent profit at both the client and project level. So this is strictly using costs associated with that project or that client. We're not putting in any overhead or anything like that, and we will do that in our next calculation. So this is just strictly looking at the project or client. So while the effective rate is driven by hours, the percent client and project margin is influenced by both hours and hourly labor costs. So here we have a project where our net revenue, so basically just we're backing out the cost of goods sold, so any project related expenses from the gross revenue. We're subtracting our labor costs. So if we had one resource that their cost is $55 an hour and they worked 100 hours, so we have a $5,500 labor cost. So the $25,000 minus the $5,500, you have your $19,500 profit. And so your project margin is 78%. So the 19.5 divided into the 25 gives you the 78%. So what should you do with this information? So just like the effective rate, this assesses how well you are scoping projects. And same thing, are certain types of projects or certain clients requiring more labor costs than what was scoped. Or are you just not scoping it well? So let's say you thought a junior level creative person could handle this project, but it turns out it required a director level person, therefore that their hourly cost was higher and made your project margin decline. And then it helps you monitor which types of projects and clients require more expensive resources, therefore lowering the margin. Well, the percent margin will help you get a better understanding of the staffing levels and needs. So it'll help you see if you are or aren't staffed at the right level, and you have to use maybe more costly freelance labor on certain projects. It'll just kind of help you think through that when you actualize at the end of a project. So next we will talk about client profitability. So this is the one I was saying is similar to the percent client margin, but we're going to now add a portion of overhead expense and attribute it to each client. So your overhead expense includes your general and administrative expenses, as well as any salary costs from billable employees that isn't attached to a billable project. That might be a little confusing, but when we do the calculation, I'll explain it a little bit more. And the client profitability goal is a very important factor when building out your annual budget, because essentially the average of your client profitability is going to be the net income on your profit and loss statement. All right, so this is where I wish we were in person so I could see if people are following me and I could point, but if you look at the top, so we have our total overhead expense of $1 million. So that's going to be your general and administrative expenses, that's right below, of the 750, plus the non-billable portion of your billable payroll. So if you look below, you've got your total billable payroll is, or your total payroll for billable staff is $550,000. And if you go all the way down to the bottom, you'll see your labor cost, and the total labor cost is $300,000. So you are using $300,000 of your billable labor, of your billable staff, is being attributed to your project work. So you have $250,000 left over. So you have the $550 is your total payroll of your billable staff. $300,000 is being attributed to projects. So you have $250,000 left over. So this top line overhead expense of $1 million is your, again, your 750 of general and administrative expenses, plus the 250 of that remainder of the payroll. So if we walk through this, so we have our net revenue, and then we have our labor cost, and we have our hours. So we're gonna allocate our overhead by our percent of effort. So in order to get our percent of effort, we're going to look at how many hours, what percentage of hours is going to each client from the total. So we have 1,000 hours on client A, divided by 3,000 total hours on the bottom. So they're using 33% of the effort, and therefore get 33% of the overhead allocation. So 33% times the $1 million in total overhead is where you get your $333,333. I hope everyone's following that. So your percent profitability, you're going to take your net revenue minus your labor cost minus your overhead allocation, and then you're going to divide that total back into your net revenue to get your 13% profitability for client A. I hope everybody followed that. If not, we'll have questions at the end. So what should you do with this information? So it's a simple way to see how each client is impacting the net income. The calculation will help you monitor how much of your billable staff salary is being accounted for on billable projects. So just kind of that wonky 550 minus the 300, the 250 left over. So obviously you want as little left over as possible when it's all said and done. This metric can also be used to evaluate the profitability of different business offerings. So if you have 3 different business segments, instead of using clients, you could set it up with those 3 different business segments and do a profitability calculation there and see which of your business segments is the most profitable. And just a kind of a note, there's different ways to allocate the overhead cost by client. Different industries do it differently. I know law firms do it differently. So I just wanted to give an idea, but so for this calculation, we were using the percent effort. So we were looking at the percent of hours, but it could be different depending on what kind of business you own. All right, moving on. So we're going to take a look now at how all of this ties together with your annual financial plan. We're going to think through setting some goals so you can see how it requires some trial and error, and how much you just have to consider when you're setting these goals, how you move one piece and another piece moves too. All right, so let's look at option 1 on the left. So you have decided that your revenue goal is going to be $3 million next year. and you currently have 10 billable employees on staff. And then we did, pretend we did a calculation, and your historical average effective rate, it comes to be about $150 an hour. And we did a historical utilization report, and historically it's 75%. So the first thing we need to do is see how many hours we have available to work based on our 10 employees and our 75% utilization average. So I'm sure everyone knows there's 2,080 hours in a year. So it's 10 times 20, 10 times 2080. So you have 20,800 total hours times the 75% gives you the 15,600 utilization hours available. So now we want to see, with our billable resources, our historical effective rate, our utilization target of 75%, will this all work with the $3 million? So we want to see what our effective rate will be with $3 million. So we take the utilization hours available and we divide it into the $3 million to get our planned effective rate, which is $192.31. Well, I'm going to look at that and I'm going to say, unless I know something like you just got a new client that is going to pay you double what everybody else pays you, it's not really feasible to increase your effective rate that much in 1 year. So we need to tweak something else. So if you look over at option 2, it's the same data points, except we tweaked the utilization. So we moved it up to 85%, and therefore we have more utilization hours available now. So we have 17,680. So that's that 20,800 times the 85%. That gives you the 17,680. And we're going to divide that in the 3 million. And now our effective rate is $169.68. So I look at this and I'm like, okay, this all seems reasonable. We have $169.68 it's an improvement from $150, but it's not completely out of range. So now we need to think about the utilization target that we just created and see if that would work. So is 85% billable utilization a realistic goal? So some things you would need to think about. Are you planning on, is that $3 million revenue goal a lot of growth next year? So you're going to have a lot of people working on new business, and therefore they're going to be hitting that productive times of the billable time. What is your company culture like? Do you expect people to work on weekends? Think through things like that. How important is work-life balance? And 85% billable is a pretty high goal. When you factor people already have holidays and PTO time and things like that come out of that 100%. So we're going to look at some kind of historical timesheet data, and we're going to think about what it means to move it from that historical 75% to 85%. So I highlighted in red some areas that would concern me. So for instance, your associate level people have to go from 90 to 95% utilized to hit this goal. And that's really hard to do. And your vice president level people would have to go from 55 to 70%, which is a 15% variance, which again, 70% may not seem that high when you're thinking about it, but at the VP level, I'm sure they're working on a lot of new business. They have teams to manage. So 70% could be pretty high, and it could be difficult to raise it, from 55 to 70% in 1 year. I mean, that's a big change in how they were operating. So I'm going to think that 85% may not be doable. So we're going to try to alter another variable. So on the left, you have that option 2 that we just talked through with the 85%. So if you look at option 3, we're going to try a different lever. So we're going to change the number of billable employees from 10 to 11. So we think that we have room in our budget to hire another employee, and we've had need for a new project manager. So this might all make sense anyways. So now we have 11 employees. We did bump up the utilization goal a little bit to 78% because that's just a 3% increase from the 75%. And we feel like that's obtainable. So again, we have another employee in here, and our effective rate would be 168.10 now. And this all seems to make a lot of sense. So as long as we can hire that extra employee, we now have our effective rate goal, we have our revenue goal, we have our utilization goal, everything, and our revenue goal of $3 million, and everything, all the pieces of the puzzle seem to be fitting together. So I hope that you guys just followed my thought process there. And I just wanted to show how your goal setting takes some trial and error to make all the puzzle pieces fit. And it's not as simple as just like, you know, there's some magical finance or accounting formula. I mean, you really have to think about your business and your culture, and if you can add resources. I mean, there's so many things to consider when you're setting these goals. So you kind of just see what works and go from there. So yeah, so it's always important to look at the full picture of the business. Always use historical data as a feasibility test. And I'm certainly not saying you have to, you know, if your effective rate has historically been 150 and you think that's terrible, and in the industry people are actually getting $200 an hour, I'm not saying to not strive for that $200 an hour, but it's probably not going to be feasible to get from 150 to 200 in 1 year. So you want to make incremental changes. And you want to set goals that are realistic, but also require some challenge. So I find sometimes that people will say, I want my revenue goal to be $5 million this year. And it's not realistic. If we go back and look at, you know, how much new business they've been adding historically versus the revenue they did last year, you know, it's just not feasible to get to the $5 million. So you want to be realistic with yourself, or you're just setting yourself up for failure from the beginning, and the rest of your financial budget won't make any sense. So cadence for tracking KPIs. So some things to think through. So when is the new data available? So timesheet data should be entered on a weekly basis. So ideally you should be able to do utilization reporting weekly. However, most other KPIs won't be available to update will be available to update on a monthly basis after the prior month accounting close. So some things that I know some smaller businesses think about. So if you don't have dedicated staff to update these KPIs, because it does take some time to do the calculations or to build out some reports in Excel, it is okay to analyze KPIs less frequently. It is okay to look at your utilization once a month instead of once a week. There is no rule on how to do it. You need to do what works for your business. Ideally, it is best to look at utilization every week, but if you can't do it, once a month is totally fine. Just always do the best you can. So now I will open it up for any questions. And if anybody has something, you know, more private that they'd like to ask, they don't want to get into their financial data, or you know, just something, you think of something later this week, feel free to shoot me an email. I'm more than happy to jump on the phone or answer any questions that anyone doesn't feel like asking right now. I hope I didn't put everyone to sleep.
Will these slides be available for us to look at?
I'm pretty sure that you guys are going to send these out after the fact. Is that right?
Sorry, Melanie, I was muted. Yeah, if you've provided them to us, we can definitely send them out if we have your permission to do so.
Yeah, of course.
helpful. Thank you.
I know a couple of people jumped on late and missed some slides. Is there any questions about revisiting anything that Melanie discussed earlier in the session? Just unmute yourself if you want to ask any questions. Melanie, any last thoughts to share?
I hope everyone's businesses are doing well and everyone's hanging in there. I know this is a really interesting time, and hopefully none of us will have to live through another one of these in our lifetimes. But if I can help any of you in any way, like seriously, please feel free to reach out. And I hope everyone learned something today. And yeah, thank you all for participating.
Melanie, I have a question.
Yeah.
Have you noticed with your clients that you've had to revisit what KPIs they had set forth at the beginning of the year because of the pandemic? Or can you give any feedback about pivots that in general that your clients have made as a result of how their businesses have been impacted?
Yeah, so we kind of are sticking to the same KPIs we have set up, but we have rebudgeted and we have adjusted the goals for the KPIs. I have most of my clients are struggling a little bit. I mean, the revenue's down, which it's kind of funny. I have one client who does live events, and you would think that they would be in the most trouble, and they're actually doing really, really well because they've been able to transition everything online. And I don't know why it's working out so well, but it is. But for the most part, we've just had to take budgets down. There have been some people have had to do staff reductions. There's going to probably be some more work we're going to have to do actually coming up here real soon when everyone's PPP money runs out. So yeah, there's definitely been some adjustments, but as far as the KPIs go, we stuck with the same ones. We've just made more adjustments to we're not as optimistic as we were in January.
Thank you. Anything else? Well, let's all give Melanie a round of applause. Thank you so much, Melanie, for joining us. And I will send the slides, and please definitely reach out to Melanie directly if you have questions that you would like to ask and follow up directly to her. She has offered the opportunity to speak with you, and I encourage you to take advantage of that. And I hope everyone enjoys the rest of this beautiful day. Thank you.
Have a good week.